In today's video, Dan Ives, global head of tech research at Wedbush Securities, joins CNBC's investment committee to break down what is really happening in the market right now. He dives into the rising excitement around the SpaceX valuation, talks through investor positioning, and explains why he believes something much bigger is going on beneath the surface. In his own words, Dan Ives says, "Something bigger is happening here," and warns that investors are about to regret this. First, I'll show you the clip from Dan Ives' interview uninterrupted so you can hear exactly what he said in context. Then I'll give you my full breakdown and reaction to his comments, including what I think investors are missing right now. After that, I'll walk you through an in-depth analysis of 3 of the best growth stocks I believe are positioned to benefit from what is happening in the market today. Let's get into it and hear what Dan Ives has to say.
SpaceX expected to begin trading at the end of the week. Leslie Picker is here with a look at how investors might be positioning ahead of that event. Maybe that's what we've seen a little bit, Leslie, in this market.
Yeah, I think it's more than just a coincidence here, Scott. SpaceX is targeting about 30% of its $75 billion offering to go to retail investors, and that cohort may be behind some of the recent volatility in the equity markets that we've seen, as that cohort sells recent winners to free up cash. Now, recently, retail investors have been chasing the upside momentum in semiconductors, in hardware, in AI power names. Micron alone has seen $6.5 billion in net retail flows in the last month, helping drive that stock's 87% upside. Now, at the same time, you've got these U.S. equity levered ETF assets, which have reached an all-time high of more than $175 billion, concentrated largely in the NASDAQ 100, as well as semiconductors. BNP Paribas believes it's not a coincidence that the NASDAQ's worst day in over a year, last Friday, came a week before the biggest IPO of all time, and it may continue. The firm says, quote, selling flows in recent winners and levered products from retail to invest in SpaceX could be very large, according to BNP Paribas. The firm hypothesizes that retail plus passive flows into the IPO could be about $50 billion. If retail sells out of levered ETFs, that can create even more disproportionate pressure ahead of the IPO, just given the magnitude of leverage involved in those products, Scott.
Okay, Leslie, thanks. That's a good look at that. You agree? Is that some of what we've seen in the NASDAQ late last week?
Oh, yeah. I think I don't know percent-wise, but I mean,
I think it's played a role.
That definitely has played a role. And I think it caused some investors to be like, okay, maybe sell some of their, massive winners, in terms of what's going to happen with SpaceX. But I do not believe this is sucking oxygen out of this market. It's a near-term blip, and I think that's what we're seeing today in terms of the rebound.
Alex, how do you think about this IPO as it's about to come to market, how you think it may perform on Friday, which is going to be a really exciting day?
Yeah, I think the valuation is definitely out of sync with reality. It's way too high, but I don't think that's going to be a problem for SpaceX. I think when you look at the hunger from retail to get into anything with momentum, joining Elon Musk's rocket company is about as good as it gets. So I expect them to have a very successful day on Friday, and I think that this stock is going to have a big pop at the very beginning.
Bryn, how are you thinking about it? Going to buy some?
Well, we already own it in quite a few funds, but I thought it was interesting. I saw over the weekend, Ron Barron, he's taking down $1 billion at IPO price to go into his funds. So, the long-term investors continue to stay in. I agree with Alex. I mean, on every metric, the valuation is insane. It will IPO like 30% more than Meta's valuation. And so that being said, there's a lot of excitement. It'll be historical. I do think between Google's raise of $85 billion, now this, if Meta does the same, we'll see. I mean, this is historical to have all of this happening at once, what type of indigestion. But I definitely think part of Friday, and also with crypto, is definitely people saying, I don't have to make it back the same way I lost it. I want to make some room for SpaceX and try to make some of that money back in this stock. So it will definitely be historic. It probably goes 2 to 2.5 trillion, which is insane on Friday.
Yeah, it'll be exciting, as I said. We really can't wait just for the spectacle of the biggest IPO we've ever seen to hit the market, especially as we have some questions about parts of the tech trade, how it's received, some of the mechanics of positioning ahead of that, and then all of it to see how it plays out.
The discussion starts with something that a lot of investors may not have considered. CNBC's Leslie Picker highlights the possibility that retail investors are selling some of their biggest winners to free up cash for the SpaceX IPO. Think about that for a moment. Over the last year, retail investors have piled into AI stocks, semiconductor companies, hardware names, and leveraged ETFs that amplify gains and losses. Many of these positions have generated enormous profits. If a once-in-a-generation IPO suddenly arrives and investors want exposure, where is the money going to come from? For many people, the answer is simple. They sell some of their existing winners. According to the discussion, retail investors have poured massive amounts of money into companies like Micron. The panel points out that semiconductor and AI-related stocks have attracted enormous inflows recently, helping fuel huge price increases. Now imagine thousands or even millions of investors all making the same decision at the same time. They look at their portfolio and think, maybe I'll trim some Nvidia, maybe I'll sell some Micron, maybe I'll reduce my semiconductor ETF, maybe I'll cash out part of my AI position. Not because they suddenly hate those companies, but because they want dry powder available for SpaceX. Personally, I think there's definitely some truth to this argument. Markets are driven by capital flows. If investors need cash for one opportunity, they often have to pull money from another opportunity. That doesn't mean the original investment thesis has changed. It simply means money is being reallocated. What's interesting is that Leslie Picker mentions BNP Paribas believes these selling flows could be substantial. They estimate that retail and passive investment flows into the IPO could reach around $50 billion. That's a staggering number. When you're talking about tens of billions of dollars potentially moving from one part of the market to another, you can absolutely create temporary volatility. But then Dan Ives jumps in with what I think is one of the most important points of the entire interview. He agrees that SpaceX has probably contributed to some recent market weakness. However, he does not believe the IPO is fundamentally sucking the oxygen out of the market. Instead, he views it as a short-term blip. And honestly, I tend to agree with him. When I look at the AI revolution, I don't see a story that suddenly changes because investors temporarily move money around ahead of one IPO. The demand for AI infrastructure hasn't disappeared. The demand for data centers hasn't disappeared. The demand for GPUs hasn't disappeared. The software transformation driven by artificial intelligence hasn't disappeared. Those secular trends are still intact. If investors sell some AI stocks to participate in a major IPO, that's more of a liquidity event than a change in the long-term investment thesis. That's why Dan Ives points to the market rebound as evidence that this selling pressure may already be proving temporary. Then the conversation shifts toward what everyone really wants to know. How will SpaceX perform once it actually starts trading? And this is where things get fascinating. Alex begins by saying something that would normally scare investors. He says the valuation is completely out of sync with reality. In other words, based on traditional valuation metrics, SpaceX looks extremely expensive. But then he immediately follows that up by saying he doesn't think it matters. That's a powerful statement. Normally, when investors hear that a company is overvalued, they assume the stock will struggle. But in today's market environment, especially with a company like SpaceX, investor psychology can sometimes become more important than valuation models in the short term. Alex argues that retail investors are hungry for momentum. They're hungry for exciting stories. They're hungry for disruptive companies. And if you're looking for a company that checks all three boxes, it's hard to find a stronger candidate than SpaceX. You're talking about Elon Musk. You're talking about rockets. You're talking about satellites. You're talking about space exploration. You're talking about one of the most iconic private companies in the world. It's basically the perfect recipe for investor enthusiasm. As a result, Alex expects a significant first-day pop, and honestly, this is where investors need to separate two completely different questions. Question number 1, will SpaceX be successful as a business? Question number 2, will SpaceX be a good stock purchase at its IPO valuation? Those are not necessarily the same question. A great company can be a terrible investment if you overpay. Likewise, a company can be wildly overvalued and still rise significantly because investor demand overwhelms supply. That's something many investors learned during previous market cycles. The panel then brings in Bryn, who takes things even further. She reveals that her funds already own SpaceX and mentions that legendary investor Ron Barron plans to invest another $1 billion at the IPO price. That detail is important because it demonstrates that institutional demand appears to remain strong despite valuation concerns. When major long-term investors continue committing capital, it sends a message to the market that they still believe in the company's future. But even Bryn admits the valuation looks insane. In fact, she repeatedly emphasizes how extreme it is. This becomes one of the most striking themes throughout the discussion. Nobody seems particularly comfortable with the valuation, yet almost everyone remains bullish on the stock's near-term trading prospects. That's a very unusual setup. Normally, high valuation and bullish sentiment don't coexist this openly. Usually investors try to justify the valuation somehow. In this case, many participants are basically saying, yes, it's expensive. Yes, the numbers look crazy, but investors may buy it anyway. That's a reminder that markets aren't always rational in the short run. Sometimes narratives dominate, sometimes excitement dominates, sometimes fear of missing out dominates, and few companies generate more fear of missing out than SpaceX. Another interesting point Bryn raises is the broader market backdrop. She notes that we're seeing massive capital raising activity occurring simultaneously. Huge amounts of money are being absorbed by the market all at once. That matters because every dollar allocated to a new opportunity is a dollar that can't be allocated somewhere else. The market has an incredible ability to absorb capital, but even it has limits over short periods of time. This helps explain why some investors may be trimming positions elsewhere. They are making room, not necessarily because they're bearish on existing holdings, but because they don't want to miss what could become a historic market event. And that brings us to one of the more psychological aspects of the interview. Bryn mentions that some investors may be looking at SpaceX as an opportunity to recover losses they've experienced elsewhere. That comment really stood out to me. Whenever investors start viewing a stock as a vehicle to quickly make money back, emotions begin entering the equation. Hope enters the equation. Greed enters the equation. Fear of missing out enters the equation. Those emotional factors can push stocks much higher than fundamentals alone would justify, but they can also create significant volatility later. Personally, whenever I hear investors talking about making money back quickly, I become more cautious. Not because the company is necessarily bad, not because the business is flawed, but because emotional buying tends to create unstable expectations. The final prediction from Bryn is perhaps the boldest statement in the entire interview. She suggests SpaceX could finish its first day with a valuation between roughly $2 trillion and $2.5 trillion. Think about what that means. We're talking about a company potentially entering public markets and immediately becoming one of the most valuable companies on Earth. That's why the panel repeatedly refers to the event as historic. Whether you're bullish or bearish, there's no denying the significance. This is not a normal IPO. This is not just another company going public. This is potentially one of the biggest public market events in modern financial history. So what's my overall takeaway from everything Dan Ives and the rest of the panel discussed? First, I do believe some recent weakness in AI and semiconductor stocks may be tied to investors raising cash for SpaceX. That explanation makes sense. Second, I agree with Dan Ives that this likely represents a temporary market dynamic rather than a fundamental threat to the AI investment thesis. Third, I think the panel is probably right that investor demand could drive a very strong debut regardless of valuation concerns. But I also think investors need to be careful about confusing excitement with value. A stock can be an incredible company and still be priced for perfection. A stock can have revolutionary technology and still experience periods of disappointment. And a stock can generate massive first-day gains while still carrying significant long-term risks. What makes the SpaceX story so fascinating is that all of those possibilities can exist simultaneously. The company may be extraordinary, the valuation may be extraordinary, the excitement may be extraordinary, and that's exactly why so many investors around the world will be watching every second of its debut. Whether you're planning to buy shares or simply observe from the sidelines, this is shaping up to be one of those rare market moments that investors will be talking about for years. Now let me show you 3 powerful growth stocks that look quietly positioned for long-term compounding right now. These are businesses that most people overlook because they are not the typical hype names you see trending every day. But underneath the surface, they sit in industries that literally keep the economy moving. The first stock is Valero Energy Corporation, ticker symbol VLO. When most people think about growth stocks, they immediately picture technology companies, software platforms, or artificial intelligence businesses. Very few investors think about oil refining, and that is exactly why Valero Energy is so interesting. Sometimes the best investment opportunities are found in industries that investors have stopped paying attention to. Valero Energy is one of the largest independent petroleum refiners in the world. The company operates an extensive network of refineries capable of processing millions of barrels of crude oil every day. Those facilities convert crude oil into products that power modern economies, including gasoline, diesel fuel, jet fuel, and petrochemicals. That might not sound exciting at first, but think about how the world functions. Every package delivered to your doorstep, every airplane carrying passengers across the globe, every truck transporting food, medicine, and consumer goods, every construction project requiring heavy equipment. All of these activities depend on refined fuel products, and that is what makes Valero's business so important. The company sits in a critical position between crude oil production and the final consumer. Without refiners like Valero, the energy supply chain simply does not work. Now here's where things become particularly interesting from an investment perspective. Building a refinery is incredibly difficult. The capital requirements are enormous. The regulatory hurdles are significant, the environmental standards are strict, and the expertise needed to operate these facilities safely and efficiently takes decades to develop. These barriers create a powerful competitive advantage. New competitors cannot simply enter the market overnight. As a result, established refiners like Valero benefit from an industry structure that naturally limits competition. That creates a moat, and moats matter. Because when you invest in a company, you're not just investing in what it does today, you're investing in its ability to protect profits and maintain market share tomorrow. Valero has spent decades building that advantage. The company operates some of the most sophisticated refining assets in North America and has developed extensive logistical capabilities that allow it to move products efficiently across major markets. This scale matters. Larger operators can often optimize production, reduce costs, and navigate market fluctuations more effectively than smaller competitors. And in an industry where margins can fluctuate significantly, operational efficiency becomes a major competitive weapon. Now let's talk about growth, because many investors hear the word energy and immediately assume growth is limited. I think that assumption misses the bigger picture. Growth does not always mean rapidly increasing revenue every year. Sometimes growth comes from improving profitability, increasing efficiency, repurchasing shares, expanding margins, and returning capital to shareholders. Valero has consistently demonstrated its ability to generate substantial free cash flow during favorable market conditions. That cash flow provides management with options. The company can invest in operations, it can strengthen its balance sheet, it can increase dividends, and it can repurchase shares. All of these actions can create shareholder value over time. One of the reasons Valero was highlighted as an attractive growth stock is its combination of earnings power and valuation. Many investors are willing to pay premium valuations for companies that may not generate meaningful profits for years. Meanwhile, businesses like Valero are already producing significant earnings and cash flow today. That disconnect can create opportunities, especially when investors become overly focused on popular sectors and ignore industries that remain essential to the global economy. Another factor worth paying attention to is energy demand itself. Despite ongoing discussions about renewable energy and electrification, the reality is that global demand for refined petroleum products remains substantial. Transportation networks continue expanding, air travel continues growing, industrial activity remains heavily dependent on fuel, developing economies continue increasing energy consumption. These trends do not disappear overnight. In fact, many analysts expect refined fuel demand to remain resilient for years to come. That provides a long runway for companies like Valero. Now, one thing I personally find interesting about Valero is how often investors underestimate the importance of infrastructure businesses. Infrastructure is rarely exciting. Nobody wakes up in the morning talking about refining capacity. But when infrastructure becomes constrained, suddenly everyone pays attention. We've seen this happen repeatedly throughout history. Periods of underinvestment can lead to tighter supply conditions. And when supply becomes constrained while demand remains strong, companies operating critical infrastructure assets can benefit significantly. Valero is positioned directly in the middle of that dynamic. The company also benefits from diversification across multiple refined products. It is not dependent on a single fuel category. Gasoline demand, diesel demand, jet fuel demand, and petrochemical demand all contribute to the broader earnings picture. That diversification can help reduce risk while maintaining exposure to multiple areas of economic activity. And when you combine that with operational scale, efficient refining assets, and disciplined capital allocation, you start to see why long-term investors continue paying attention to this company. Another important point involves shareholder returns. Many growth investors focus exclusively on stock price appreciation, but total returns matter. If a company generates strong cash flow and consistently returns capital to shareholders, investors benefit benefit from multiple value creation mechanisms. Valero has built a reputation for rewarding shareholders through dividends and buybacks. Over long periods, those returns can compound meaningfully, especially when shares are repurchased at attractive valuations. Now let's consider risk. No investment is without risk. Energy markets can be volatile, commodity prices fluctuate, economic slowdowns can impact demand, refining margins can expand and contract. These realities are part of the business. However, successful investing is not about avoiding all risk. It's about understanding whether the potential reward adequately compensates you for the risks involved. And in Valero's case, many investors believe the company's competitive position, cash generation capabilities, and essential role within the energy ecosystem provide a compelling risk-reward profile. The key takeaway here is that Valero is not simply an oil company, it is an infrastructure company, it is a logistics company, it is a cash flow machine, and perhaps most importantly, it is a business that remains deeply embedded in how the modern economy functions. That combination makes it one of the more intriguing growth opportunities for investors looking beyond the obvious names dominating financial headlines. As investors, it is easy to become distracted by whatever is trending today. But some of the best opportunities emerge when you focus on businesses providing essential services that the world cannot easily operate without. Valero fits that description remarkably well, and that is why it earns a spot on this list of growth stocks to buy now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on our list is H&R Block Incorporated, ticker symbol HRB. Now, I know what some investors might be thinking. A tax preparation company? How can a tax company possibly qualify as one of the best growth stocks to buy right now? And honestly, that's exactly why I wanted to include it, because some of the strongest investment opportunities are hiding in plain sight. While investors chase the latest market trends, H&R Block continues operating a business that millions of Americans rely on every single year. Think about it. Technology changes, consumer trends change, economic cycles come and go. But one thing remains remarkably consistent. People have to file their taxes. That simple reality creates one of the most predictable demand profiles you will find in the entire market. Every year, millions of individuals, families, self-employed workers, freelancers, small business owners, and retirees need help preparing and filing their taxes. And H&R Block has spent decades building trust with those customers. That trust is incredibly valuable, because taxes are personal. People are sharing sensitive financial information. They want accuracy, they want reliability, and they want confidence that everything is being handled correctly. Once a customer develops trust in a provider, they often return year after year. That creates recurring revenue opportunities that many investors underestimate. This is one of the reasons I find H&R Block so fascinating as an investment. The company operates in an industry where customer relationships can last for decades. That type of loyalty is difficult to replicate, and it creates a powerful competitive advantage. Now let's talk about the business model. Many people still think of H&R Block as simply a chain of tax offices, but the company has evolved significantly. Today, H&R Block operates through a combination of physical locations, digital tax preparation software, virtual assistant services, and professional tax expertise. That hybrid model allows the company to serve customers however they prefer. Some people want face-to-face guidance. Others want to file entirely online. Many want something in between. H&R Block can accommodate all of those preferences, and that flexibility is becoming increasingly important. The company's ability to blend traditional services with digital solutions helps it remain relevant in a rapidly changing marketplace. Instead of fighting technological change, H&R Block has adapted alongside it. That adaptability matters because businesses that fail to evolve often struggle to maintain market share over time. H&R Block has demonstrated that it understands this challenge, and so far management has executed that transition effectively. Now let's look at another reason why this business deserves attention. Tax laws continue becoming more complicated. Every year, new rules, deductions, credits, reporting requirements, and compliance issues emerge. For many consumers, navigating these complexities alone can be stressful. That complexity actually works in H&R Block's favor, because the more complicated taxes become, the more valuable professional guidance becomes. In other words, complexity creates demand, and demand supports long-term business relevance. This dynamic helps protect the company's position within the marketplace. The need for tax expertise does not disappear simply because software exists. In many cases, the opposite happens. As financial situations become more complicated, consumers often seek additional support. That creates opportunities for companies with established expertise and trusted brands. Another thing I like about H&R Block is its financial profile. Unlike many businesses that require massive capital expenditures just to maintain operations, H&R Block generates substantial cash flow without needing enormous ongoing investments in physical infrastructure. That allows more cash to be directed toward shareholder returns, and management has taken advantage of that flexibility. The company has consistently returned capital to shareholders through dividends and share repurchases. Those buybacks are particularly interesting. When a company repurchases shares, each remaining shareholder owns a slightly larger piece of the business. Over time, that can meaningfully increase shareholder value, especially when those buybacks occur at attractive valuations. This is one of the hidden drivers of long-term wealth creation that many investors overlook. Everyone focuses on revenue growth. Everyone focuses on earnings growth. But disciplined capital allocation can be just as important. And H&R Block has demonstrated a willingness to reward shareholders over time. Now let's discuss why HRB appeared among attractive growth stock selections. One of the most compelling aspects of the company is its combination of stability and profitability. Markets often become obsessed with high-growth stories that may or may not generate meaningful profits in the future. Meanwhile, H&R Block is already generating profits today. The company has an established customer base, a recognized brand, strong cash generation, and recurring demand. Those characteristics provide a foundation that many speculative businesses simply do not possess. From my perspective, there is something refreshing about investing in a company where the business model is easy to understand. You do not need to make assumptions about technologies that may or may not succeed 10 years from now. You do not need to predict entirely new industries. You simply need to evaluate whether millions of people will continue needing tax assistance. And honestly, that seems like a fairly reasonable assumption. Now, does that mean H&R Block will suddenly double overnight? Probably not. But successful investing is not always about finding the fastest growing company. Sometimes it is about finding quality businesses capable of steadily compounding shareholder value over long periods. And that is where H&R Block shines. The company benefits from recurring demand. It possesses strong brand recognition. It generates healthy cash flow. It returns capital to shareholders. And it continues adapting to changes in consumer behavior. Those characteristics create a compelling investment case. There is also a broader lesson here. Many investors limit themselves to a narrow definition of growth. They assume growth only exists in industries generating headlines, but growth can come from operational improvements, market share gains, customer retention, digital expansion, share repurchases, and disciplined capital allocation. H&R Block demonstrates that perfectly. The business may not be flashy, but it continues creating value, and over long periods, value creation is what ultimately drives investment returns. Personally, I think that is one of the reasons this stock remains so interesting. It sits in a category many investors ignore, yet it continues producing results. And sometimes those overlooked opportunities end up delivering the most satisfying returns, because expectations are already low. The market does not need perfection. The company simply needs to continue executing. And so far, management has demonstrated an ability to do exactly that. For investors seeking a combination of resilience, profitability, recurring demand, and long-term relevance, H&R Block deserves serious consideration. It may not dominate financial headlines, but it does dominate a business that millions of people depend on every year, and that creates a foundation for durable long-term growth. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on our list is Marathon Petroleum Corporation, ticker symbol MPC. If you've stayed with me this far, you've probably noticed a theme. None of the companies we've discussed today are dependent on hype. None of them require investors to believe in a revolutionary technology that may or may not succeed. Instead, they operate in industries that already matter today. And Marathon Petroleum may be one of the best examples of that idea. This is a company deeply embedded in the infrastructure that keeps the economy functioning. Every day, Fuel moves through a vast network of refineries, pipelines, storage facilities, transportation systems, and distribution channels before it ever reaches consumers. Most people never think about that process, but without it, modern life would quickly grind to a halt. Marathon Petroleum sits right in the middle of that system. The company is one of the largest downstream energy businesses in the United States. Its operations include refining crude oil into valuable petroleum products and moving those products through extensive logistics and transportation networks. This combination is important because Marathon Petroleum is not simply a refiner. It is an integrated energy infrastructure company, and integration creates advantages. Think about it this way. When a company controls more pieces of the value chain, it often gains greater flexibility, improved efficiency, and stronger economics. That is exactly what Marathon Petroleum has built. Its refining operations generate fuel products. Its logistics infrastructure helps transport those products. Its storage and distribution capabilities help ensure efficient delivery to end markets. All of these pieces work together, and that integration creates a competitive position that would be extremely difficult and expensive to replicate. One of the things I personally find most attractive about businesses like Marathon Petroleum is the sheer scale involved. Large-scale infrastructure assets create barriers that discourage competition. Building new refining capacity is expensive. Constructing transportation networks is expensive. Developing storage facilities is expensive. Obtaining permits is difficult. Meeting regulatory requirements is difficult. These barriers help protect established operators, and when you combine those barriers with decades of operational expertise, you create a business that can maintain relevance for a very long time. Now let's talk about demand, because this is where many investors make incorrect assumptions. Every few years, predictions emerge suggesting traditional energy demand is about to collapse. Yet the reality has often been far more complicated. Transportation systems continue requiring fuel. Commercial aviation continues requiring fuel. Industrial operations continue requiring fuel. Freight transportation continues requiring fuel. Economic activity remains deeply connected to energy consumption. That does not mean energy markets never change. Of course they do. But the transition tends to happen gradually rather than overnight. And during that transition, companies with strong infrastructure positions can continue generating substantial cash flow. Marathon Petroleum benefits from exactly that dynamic. Its assets remain critical to serving existing energy demand. And because energy demand remains significant, those assets continue generating value. Another reason investors pay attention to Marathon Petroleum is its ability to generate strong free cash flow. Cash flow is one of the most important metrics in investing. After all, cash flow represents real money flowing into the business, and when a company consistently generates substantial cash flow, management gains flexibility, it can invest in growth initiatives, it can strengthen the balance sheet, it can pursue strategic opportunities, and it can return capital to shareholders. Marathon Petroleum has developed a reputation for doing exactly that. The company has historically returned significant amounts of capital through dividends and share repurchases. That matters more than many investors realize. Imagine two businesses generating similar profits. One retains all of those profits. The other actively returns cash to shareholders while reducing its share count. Over long periods, the second approach can create powerful compounding effects. Each repurchased share increases ownership percentages for remaining shareholders, and as earnings continue flowing through a smaller share base, per-share results can improve. This is one reason why disciplined capital allocation is such an important characteristic. Management teams that allocate capital effectively can create tremendous shareholder value over time, and Marathon Petroleum has demonstrated a strong commitment to that philosophy. Now let's step back and compare all three businesses we've discussed today. Valero Energy benefits from its position as one of the largest independent refiners in the world. Its infrastructure, scale, and cash generation capabilities provide a foundation for long-term value creation. H&R Block benefits from recurring consumer demand, strong customer relationships, and a business model tied to an activity that millions of people must complete every year. Marathon Petroleum benefits from integrated energy infrastructure, extensive logistics assets, and an essential role within the transportation economy. At first glance, these companies may appear completely different, but they share several important characteristics. Each has demonstrated a willingness to return capital to shareholders. Those are not temporary advantages. Those are characteristics that can support long-term wealth creation. Sometimes the best approach is identifying quality businesses, understanding why they matter, and allowing time to work in your favor. That is exactly why Valero Energy, H&R Block, and Marathon Petroleum earned a place on today's list. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I would love to hear from you. Of the 3 companies we discussed today, which business do you believe has the strongest long-term competitive advantage? Let me know in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.